All right, everybody, let's get started on this workshop today. Actually, perfect. All righty. Sorry about that. Send one quick message. But anyhow, let's get started on today's workshop. Today's all about Roth conversions, what they are, who they're right for, all that kind of stuff around there. This is probably a very popular topic, mainly because I get this question a lot. What is Roth? What's the value in it? That kind of stuff there. Cool. So for those of you who are new, haven't been to one of our workshops before, I'm Chris Price. I'm one of our certified financial planners. And I really spend my time just really educating the community, educating my clients on all things finances. Today, like I said, is all about Roth conversion. So what do we have on the agenda today? Well, we're obviously going to talk about Roth basics. What is a Roth? How does it help? Those kind of things. We're going to talk about a huge topic, backdoor Roth IRAs. So this isn't so much as a product, but a process or a solution for some of those who can't get a Roth IRA. But stay tuned for that. That's something a lot of people are going to want to listen to. Then we have Roth IRA conversions that maximize retirement income, or Roth IRA conversions that actually help a legacy, which is a newer process that's used now. We're talking about those next generations. So, cool. And for those of you, just so you know, which I forgot to mention, for those of you who may have some questions, send us an email. I'll make sure I address them later on in the presentation if I don't address them earlier. So definitely send that email. You'll see my email throughout this thing, which is christopherprice@financialguide.com. But let's first start with what is an IRA. So an IRA, in the grand scheme of retirement planning, was established relatively new in 1998. It was actually named after a senator who was really the sponsor of this legislation. And his name was William Roth. And the whole point of the goal of this was to actually increase the current taxable revenue. We'll talk a little bit about the difference between a traditional IRA and a Roth IRA. But to really sum it up, it's about when you pay those taxes. A traditional is upfront. A Roth is upfront, where a traditional is postponed. So it helped us increase our tax revenue during that time frame. So again, and the primary focus for us as individuals, as citizens, is it allows us to have tax-free tomorrow, right? We'll pay our taxes today, and the profits we make will be tax-free for tomorrow. So let's talk about who can contribute to an IRA. Well, to be able to contribute to an IRA, it's very, very simple. You really just need to meet these two requirements. The first requirement is have earned income. So if you're somebody who doesn't have any earned income, you can't contribute to a Roth IRA. And mind you, I use the word earned income. So there's a difference between income and earned income. There's many different kinds of income. You could have passive income, you could have business income, you could have rental income, you could have investment income. This is talking about earned income from a job. The next one is you have to meet the modified adjusted gross income limits. That's basically a term that your accountant is very familiar with, and you might have seen it, your AGI, your MAGI limits, which we'll talk about in a little bit. But if you make too much money, we have to work on different strategy to contribute to our Roth. Cool. So let's first talk about how much we can give. So as everybody out there who's probably been part of a retirement account before knows, there's a maximum you can give to your retirement accounts. So if we're actually talking about a Roth IRA and only a Roth IRA, the max we could give for 2025 is $7,000 if we're under 50, or $8,000 if we're over 50. Now, mind you, this number is due to change. It always does. Every year, there could be adjustments made. So keep that in mind. The numbers I'm giving you now are for today, but maybe in 2026, those numbers could be different. If we look at this, we see if your modified adjusted gross income exceeds IRS limits, this number could be different. That would be that rule 2 we talked about, which we will continue to talk about. So I know all of you are looking at your screen right now. You're seeing a chart with a bunch of numbers, a bunch of incomes, and you're maybe wondering what it means. I will just keep it short and sweet for this. If this is a concern for you or a question you want more on, as you know from being part of other workshops, call us, reach out to us, and we'll define what matters to you and which one of these categories you're in. But let's kind of quantify what's here. So what this is saying is if you make a certain amount of money, you have less ability to contribute to a Roth. So the first one, if you're married filing jointly and you guys as a couple make less than $236,000, you could give that full $7,000 or $8,000 that we saw up here in this slide. But if you are in between $236,000 and $46,000, you could only do a certain amount. That's what we call our phase out period, meaning the more you're making, the more you're phasing out the ability to give to a Roth IRA. And if you're making above $246,000, you cannot contribute to a Roth IRA. Now, there's ways around it. We'll talk about it, but that you can't traditionally contribute to a Roth IRA. And this goes true for married filing separate, single, head of household, things of that nature. Cool. So for those of you who are making above that amount, that's where you get this backdoor Roth scenario, which is something that you might heard of and is quite popular. I a lot of times get people who call me because they might have heard this term and ask, hey, I want to do a backdoor Roth. How do I do a backdoor Roth? And that's really the answer here. So a backdoor Roth is only for those individuals who are above this threshold, above that $236,000 or $246,000 if they're married, or if they're single, above $150,000 or $165,000. If you're above that, you can execute a backdoor Roth IRA. Now, what this allows you to do is use a traditional IRA to put into a Roth IRA. So if you are above that limit and you prefer to make after-tax contributions and grow the money tax-free, this Roth or this idea might be right for you. There is a catch. There's always a catch, and we'll talk about that. So backdoor Roth, why do it, right? How you do it. To do a backdoor Roth, you make a non-deductible contribution to your traditional IRA. So for those of you who are unfamiliar with the traditional IRA, we have a whole section on that. But basically, you can give to a traditional IRA as long as you have earned income. That's the only rule. There's no income requirement, just the income you're getting. So if you have earned income, you can receive or you can make a contribution to a traditional IRA. Now, because you're going to do a backdoor Roth, you're not going to want to take a current tax deduction. So you're going to do what they call a non-deductible contribution to that traditional IRA. So this also means that it doesn't matter if you have a plan at work or not, this still works. Again, like I stated, there's no income restriction. And then you would immediately convert that traditional IRA to a Roth because there's no income restriction on that conversion. So that's the key, right? If you want to be able to contribute to a Roth IRA, you have to have earned income and you have to be under that modified adjusted gross income that we talked about. Now, if you want to convert to a Roth, that income limits don't apply. So how a backdoor Roth works, to summarize what this slide says, is you put money into a traditional IRA and then you automatically convert it to a Roth IRA. But I'm sure some of you might have picked up a word I said a little bit ago about there's always a catch. We'll talk about that also. So here's some of the catches. Strategies doesn't always work for those with traditional IRAs already. So if you already have a traditional IRA, this backdoor Roth becomes a little bit more complex than you may think. Not unheard of, not impossible, just a little bit more complex. And let's talk a little bit about that. So the reason it becomes complex is all your traditional IRAs are valued as an aggregate of the end of that year. So and we'll do an example, but if you have already IRA set up and you decide you want to do a backdoor Roth IRA strategy, everything comes into effect, not just the account you're trying to do this backdoor Roth IRA. And actually what they use a pro rata calculation to determine how much of taxes you have to pay today to be able to do that conversion. For those who are really into it, it's form 8606. So let's use an example here. Let's say Mark is age 40. He decides he wants to make a $6,500 after-tax contribution in November 14th, 2022 to his traditional IRA, and then he wants to convert it to a Roth the next day. So he does that Roth conversion that we talked about, but he has an IRA somewhere else, right? So he does that backdoor conversion we talked about. He has an IRA somewhere else. So Mark has another IRA, as we talked about, that has $100,000. And again, they value it as of that end of that year. So Mark's aggregation on 12/31 of his traditional IRA balance of 100 grand and the 6,500 that he converted to equals the 106.50. So basically, to keep that simple from where we are now, is he had a $100,000 IRA already. He wants to do the backdoor Roth. He puts in $6,500. They're going to say that, okay, at the end of that year, he had about $6,500 in IRAs. Well, to do the pro rata calculation and move that $6,500 to a Roth, they're going to come up with how much of that amount is a tax-free transfer, which in this case, you'll see on line 4, which is $397. I know I'm going through a lot of numbers, and I'll summarize them here as soon as we get done with the slide. So that means the non-taxable portion is $397, and the taxable portion is $6,107. So I know it was a mouthful. I know it's a lot of numbers. Let's kind of break that down to what we see here. Mark is age 40. He wants to do a backdoor Roth contribution. He puts in $6,500 to his traditional and moves it to his Roth. He already has a traditional somewhere else that has $100,000 in it. The IRS commingles those and says, hey, they all count as one for this transaction that you're trying to perform. They say, okay, well, if we add those together, we have $100,065. They're going to look at the pro rata amount, the amount you moved over to a Roth and the total amount you have, and they're going to come up with that calculation. What is that number that is tax-free? In this case, $397. That means all the others is considered a taxable transaction, meaning you'll pay taxes on $6,103. For those of you who have questions on this, definitely call me. We'll do the exact calculations for you in your particular scenario. So, why would someone want to do a Roth conversion? We talked about how we get into Roths. Now, why would someone want to do a Roth conversion? Well, maybe they're expecting higher taxes into the future. Right? Remember, a Roth is you pay your tax today and everything it grows to is tax-free. So if I think taxes are going to be more into the future, I'm going to want to pay them today. Right? So maybe we're trying to do something to lower our estate or gift tax. This is for those individuals who might have an estate tax or a gift tax issue. And those we could talk about in a further slide, but maybe they want to do that. And then the last but not least is there is new ways where IRAs are taxed or have to be distributed once you pass. And that's a Secure Act 10-year post-death IRA period, which we'll get into. That is the newest thing when it comes to Roths that just came out a few years ago. So let's look on the first one, expecting higher future income tax rates. Right now, we're still in a lower tax rate environment due to the Tax Cut and Job Act of 2017. If we look at our slide, we can see what our tax rate is based on the maximum amount of income. So we'll use an example. If you're a single person and you made $110,000, you would be in that 24% tax rate. The reason I bring that up is if there is no changes on the tax code this year, which we don't know if there's going to be or not, but if there's not, all those tax rates are going to go up. They're right now they're at 10, 12, 22, 24, 32, 35, 37. They will go up to 10, 15, 25, 28, 33, 35, and 39.6. So if we don't think there's going to be any changes, this might be a good year to take advantage of Roths, because next year your income tax might be higher. All right. Second part to that previous slide is that Secure Act, the new post-death RMD requirements. Now, for anybody who maybe has inherited an IRA before, or thinks you might inherit an IRA due to a parent, maybe spouse that's older or something like that, this is a huge factor that you have to play in, because the rules are not nearly as simple now as they were 10 years ago. Right now, if you have an IRA, and this is traditional or Roth, and God forbid someone's a pass and you inherit it, they're going to define you in 3 different beneficiary categories. One's a designated beneficiary, one's an eligible designated beneficiary, and one is no designated beneficiary at all. We're not going to talk about the last one. That is when someone doesn't put a beneficiary on our IRA. And I think everybody on here should know we need to put a beneficiary on our IRA. Whoops. Ahead of myself. Cool. So designated beneficiary. So now, which is different, is there's a 10-year rule that applies when you inherit an IRA, meaning you have to make sure that you take out every dollar within that 10 years. Now, if that person was before RMD requirements, which means they were younger than, let's say, 73 right now, then you would have to also not just take it all out within 10 years, but take some out every single year. And if that person was not of that age, they were younger than that, and they were not taking out RMDs, then you would just have to make sure that account is liquidated within 10 years. So to summarize what that says, if you inherit an IRA and you are the beneficiary, you will have to take that money out within 10 years. If that person was older, means 73 and older, you would have had to take out every single year, but it all would have had to been out in 10 years. I think in this one. Okay. Okay. So why should we consider, or who should consider, a Roth conversion in this IRA? I think there's a slide that was supposed to be in there about eligible beneficiaries. Hopefully it's later on, because it definitely should be in this presentation. But nevertheless, who should consider a Roth IRA conversion? So in general, an IRA owner or qualified plan participants should consider it, again, if there is going to be a higher reason for taxes later on. One that we didn't talk about was controlling RMDs, and we'll talk about that in a little bit. RMDs are the amount they require to take out, but you don't have to if you have a Roth IRA. And the last but not least, we'll see on our slide, and that's the next generation may be more benefited if they inherited a Roth instead of an IRA. All right. So let's weigh the trade-offs. Let's find out, should you be somebody who keeps your traditional IRA, or should you be someone who converts to a Roth IRA? On your slide right here, you're going to really see which one would be more beneficial or less beneficial to converting your Roth IRA. So if you're someone who thinks that future tax rates will be higher in the future, it's going to be more beneficial. You see on your screen. If you think future tax rates will be lower in the future, then it's less beneficial and you should keep that traditional IRA. let's say, do you need the income from your IRA, or, and when do you need that income from your IRA? If you never see yourself needing that money that you have in your IRA, it's going to be more beneficial to put it into a Roth. But if you're going to use that pretty soon, it'll be less beneficial. And then again, paying out of taxes, asset appreciation, time horizon. Asset appreciation, time horizon is a big one. We all hear that the younger you are, the better it is to be Roth. And that's on this two factors right here. The longer time we have and the more the asset appreciates, the better it is to be in Roth over traditional. And we see that. We see that here. Now, let's talk about something that is less common in why we would do Roth conversions, and that's legacy planning. So unlike a spouse or something of that nature, when we want to plan a legacy, we want to see, okay, what's the best benefit to be able to provide that legacy a better bang for their buck. Let's see if we could take the IRS or the taxes out of it. And this is kind of a strategy that allows us to do that. So a Roth conversion, again, we don't have to take out RMDs. So we don't have to take out as much throughout our life. And it grows tax-free, which is huge. So let's do a little example. So let's see that we have a woman named Tracy. She's 67 years old right now. She has enough income, doesn't need any more income. Her current tax rate's at 32%. And she's worried that the conversion would increase her taxes. And if it does, it will increase it to 35%. It's a reason why she wouldn't want to do it. Right? She does have a pretty nice investment portfolio, has about $250,000 in a traditional IRA. And that's the one we're talking about if we should convert or not, but doesn't expect to need any of that income. So she has a goal. If I left this 250 to my beneficiaries, what's the best way to do that for myself and for the beneficiaries? So John's the beneficiary, right? Right now, John's 38 years old. He's a successful business owner, and he's married with 2 kids. He's currently at that same 35% income tax rate, but he is worried that his taxes are going to go up. So a inheritance may increase those taxes to 35%. Right? He doesn't need or want anything from his mom's estate, but his mom does want to provide that to him. Let's talk about the little strategy we might use. So first, let's talk about if we do not convert at all. What's going to happen to those mothers' assets if we're not going to convert? So we're going to make the same assumptions we talked about. We see our chart with Tracy, we see that there's $250,000 in that IRA, right? And we see that at age 90, it should be approximately about $371,000. Now that has to do with, we have to take out RMDs starting at 73, like we talked about, and we're paying taxes when we do that. If you look a little bit to the right, we see that she also has a side account of about $87,000. The reason this chart has that is to show how much taxes would have been paid if she did convert. And we could see at 90, she has about $633,000 in there. So basically the money from the IRA came out because of RMDs, was taxed, and then put into that investment account that was earning 6%. At passing, we can see John, he inherited an IRA of about $371,000, and that extra side account that money went into about $633,000. Well, mind you, John had 10 years to take that money out. So at 10 years after, you could see he had $0 in his IRA, right? He had to take that money out and just put it into this side account with about $1.1 million. So that's basically what would happen if she didn't do the conversion. They made 6% every year for those number of years. Now let's talk about if she did do the conversion. Well, if she did do the conversion, you can see some of the differences. That $250,000 in her IRA continues to grow to about $1 million and change by the time she's 90. We see nothing in that side account. We see nothing there because no money had to come out due to RMDs. Right? Once she was to pass, John inherited that entire IRA. And yes, he had 10 years to take it out, but he didn't have to pay any tax on it. So we could see at 70, he had about 1.8 instead of the other previous where he had 1.1. So in this strategy, it'd be really, really great for her to convert, even though it's against some of the things I said earlier about who will benefit when to convert and who wouldn't. So this presentation had a lot of different numbers in it and a lot of different maybe questions that came from it. So I want to encourage everyone who does have questions, definitely reach out to us. Use the QR code. Make sure we answer the questions that are relevant to you. And we look forward to seeing you on the next one.